If you were worried about the debt of the USA, then hold on to your heart, because the figure for global debt is even more alarming. In a report issued by the Institute of International Finance in November last year, the global debt hit a new high of over $250 trillion for the first half of 2019. According to the report, China and the US were two of the biggest contributors to global debt. The IIF said the overall number hit $250.9 trillion at the end of this period and will exceed $255 trillion by the end of 2019. The report stated China and the US accounted for over 60% of the increase. With few signs of slowdown in the pace of debt accumulation, we estimate that global debt will surpass $255 trillion this year, the IIF said in the report. The graph on your screen now shows the accumulation of global debt. It was around $100 trillion in 1999, and 2 decades later it is close to $300 trillion. Rising debt across the world has been a big concern for investors and has also been flagged as the next breaking point by a number of economists. Record low interest rates make it extremely easy for corporates and sovereigns to borrow more money. The IMF also warned at the end of 2019 that almost 40%, or around $19 trillion of the corporate debt in major economies such as the US, China, Japan, Germany, Britain, France, Italy, and Spain was at risk of default in the event of another global economic downturn. The IIF cites the deepening of global bond markets as the reason for the rise in debt levels. The global bond markets increased from $87 trillion in 2009 to over $115 trillion in mid-2019. The growth was mostly seen in the government bond market, which now makes up 47% of global bond markets compared to 40% in 2009. The bond universe has grown most rapidly in emerging markets, swelling by over $17 trillion to near $28 trillion since 2009, the report stated. The global government bond market, especially the so-called safe haven assets, such as U.S. Treasuries, have been very crowded lately as investors rush to safer assets amid uncertainty due to Brexit, a global growth slowdown, and President Donald Trump's impeachment inquiry in the U.S. This brings us to the next issue of concern. The IIF report stated that the global bond market has deepened and it has contributed to the increase in global debt, and we can imply that it has also resulted in an increase in United States debt. Let us first understand what the bond market is and why it is so important. Investors and policymakers have long relied on one bond market indicator to gauge whether or not a U.S. financial crisis is close. That indicator is the U.S. yield curve. Typically, short-term interest rates are lower than long-term interest rates because investors demand a bit more compensation to lend on a longer-term basis. This is also known as the risk premium. Whenever an investor invests, they require a return on investment, and this return comprises of the risk inherent in the investment and the time value of money. Since the risk of loss is generally low in the short term and time value of money does not change much in the short term either, the short-term rates are lower as compared to long-term interest rates, where the time factor and uncertainty in predicting future risk attaches a high risk value to long-term interest rates, thus making them higher than short-term interest rates. This is what a typical U.S. yield curve looks like. When this relationship reverses and short-term yields rise higher than long-term yields, people often take this as an indication that monetary policy is just too tight and economic slowdown could be coming, and that the Fed is going to have to lower interest rates in order to protect the economy. What that leads is for long-term rates to come down below that of short-term rates, and that leads the U.S. yield curve to invert or turn negative, and it looks like this. This is the inverted yield curve. It can be seen that in the short term the yield goes up. This is an exact inverse of the normal yield curve. People pay attention to when the US yield curve inverts because it has turned negative before every US economic meltdown of the last 50 years. Well, let us take a look at the 10-year Treasury yield because this graph has certainly got tales to tell. The chart shows the daily 10-year Treasury yield back to 1962. The 10-year Treasury is the benchmark used to decide mortgage rates across the United States and is the most liquid and widely traded bond in the world. The current 10-year Treasury yield as of January 7, 2020 is 1.83%. Let us first look at what this graph is telling us. The shaded columns indicate economic collapse. The U.S. has had 7 financial meltdowns since 1962. You can notice that before each financial crisis, the yield curve turned inverse. Let us have a closer look at each period of economic crisis. This graph shows the 1970 stock market crash. You can see that in July to October, the yield curve rates were dropped to boost spending, and they had a temporary effect on the economy, but soon the economy went into a financial crash. At the end of October 1970, the Fed had to slash the rates again to boost spending, and so the rates dropped from about 7.3% to almost 5.5% in April 1971. By the way, it was in the 70s when President Nixon decoupled the dollar with gold and abolished the gold standard basically forever. This decoupling caused the market crash of the 70s. Now, we'll discuss this in upcoming videos. For the moment, let us stay fixed on the yield curve. The market crash of 1974 shows us a similar picture. So, see how the yield curve went inverse right before the hit. Remember that in 75, the gold standard did not exist. This is now the beginning of the era of fiat currency. Interest rates were raised by March 75 to create a deflationary pressure and stabilize the economy, and it seems to have worked back then. Look at this next graph that shows the depressions in the 1980s. Once again, you can see that the yield curve went inverse just before both crashes. And at this point, it's worth noting that when the yield curve goes inverse, the Fed tried to raise the policy rates to bring the rate up and to correct it. So yield inversion is almost always followed by a rise in rates to induce the curve to become normal again. Once again, the curve went inverse before the depression. And once again, in both crashes, the yield curve can be seen going inverse. Now, so far, we've established that the yield curve always goes inverse before a crash. Now, you can say that the graphs show that the curve has also gone inverse in many other places where crashes have not hit. True, it is not necessary for a crash to occur every time the yield curve goes negative, but whenever a crash has hit, yield curve has always been negative right before it. Let's look at the bigger picture once again to make sense of all of this. This is the 10-year Treasury constant maturity minus 2-year constant maturity. This graph simply shows the yield curve inversion in much better detail. Economists use this graph for simplicity. It takes out a lot of noise. Here, it can clearly be seen that before each crash, the yield curve went inverse and touched the 0% mark. Last year, June to October, the yield curve remained inverse for a period of almost 3 months, and it has since then recovered only because the Fed raised the rates twice after that. So what does this mean? When the yield curve inverts, short-term interest rates become higher than long-term rates. This type of yield curve is the rarest of the 3 main curve types and is considered to be a predictor of economic crash. Because of the rarity of yield curve inversions, they typically draw attention from all parts of the financial world. This means that the yield curve is one of the key ingredients of a coming crash. The latest inversion ended in October. So, are we lucky, or are we still in the danger zone for the upcoming economic meltdown?